Recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats have shaken business and consumer confidence. This is restraining household spending intentions and businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation.
The Bank of Canada back at it today with a 25 basis point cut to its key lending rate, sitting now at 2.75%. It's the seventh cut in a row. But Bank of Canada Governor Tiff Macklem's announcement comes with a stark warning. Being in a trade war with our closest trading partner is a weight on the economy that increases prices and inflation. Here to unpack what all of that means for you is RBC's chief economist, Frances Donald. Hi, Ms. Donald. Good to have you back on the program. Thank you very much for making the time.
Thank you for having me.
Do you think this cut would have happened in the absence of the threat of tariffs and all the uncertainty that that has created?
Probably. Even before the trade war came upon our shores, most economists were looking for interest rates to fall to 2.5% or below. We've been in the 2.25% camp for a while. And that's because this economy was, frankly, still recovering from that high interest rate shock. The unemployment rate still steadily creeping a little bit higher, and general activity levels were still very low. So the path is not being disrupted. The question now is how much more will the Bank of Canada go because trade is weighing on growth in the first quarter. And right now, the Bank of Canada, like all economists, dealing with a pretty significant problem, which is most of our data tells us where we were in December and January. December and January is not where we are now. So we're in a vacuum of information, and the Bank of Canada, like many of us, is having to put a couple puzzle pieces together to get a sense of what February and March will look like.
And what kinds of puzzle pieces will are the ones to watch to figure out what that scenario will look like?
Well, we can look at sentiment data. We got a little bit more of that. But what the Bank of Canada did today was really interesting, which is they conducted their own survey. They asked business and households, are you worried about your job? Are you going to be pulling back on investment? That's not something they've done before. So they actually stepped out of process to try to gather more information for this decision. And that survey data, which is one of our most recent pieces of new information, well, it didn't look particularly optimistic. It said that households were worried about higher prices. They were worried about their jobs across a variety of sectors. And businesses said not only are they intending to increase prices, but pull back on hiring and investment. So while today was probably going to be a cut, maybe some folks would have been on the fence about that. That survey data likely cemented it for the Bank of Canada and probably means we see another cut in April.
I thought the other interesting thing that stuck out for me from the comments today from Governor Macklem were something that he had repeated actually from the last time that he had delivered an announcement, and that is kind of like a warning: don't expect monetary policy by itself to be able to address the impacts of this trade war. Can you unpack that for us? What does that mean in layman's terms?
Well, I think what the Bank of Canada is trying to nod to is that this is a job for fiscal policy, that what Canada is going to need in the next 3 months, 6 months, or a year isn't necessarily lower interest rates. Lower interest rates will help cushion the blow a little bit, but lower interest rates don't recalibrate the economy. They certainly don't do anything to influence President Trump's policies on tariffs. They're probably actually going to increase some inflation in places like housing. So to me, this is Governor Macklem explaining, listen, we need government money at provincial level and federal money to go into the economy where it's most needed. Very targeted support to the industries and the households that are directly impacted. Because at the end of the day, this is a Bank of Canada and a Canadian population that is still scarred from one of the largest price increases of most folks' lifetime that we're still recovering from. Prices up over 20% since before COVID. If the Bank of Canada just blanket eases monetary policy for everyone, even high-income folks, older demographics who don't need it, they actually risk having inflation move higher. That wouldn't do anything to combat tariffs. It wouldn't help reinvigorate our export sector, and it would make the inflation problem worse. So the Bank of Canada wants to help on around the sides here, but this is, to me, them saying we need fiscal policy to do the bulk of this lifting.
So how worried should Canadians be then when you lay all that out about the possibility of prices, which inflation has certainly slowed, but we're living in a world where, and you and I both know this, anyone who does the grocery shopping does, it's way more expensive than it was 2 years ago or 3 years ago to just get the basic necessities. If there does have to be targeted support, and yes, targeted, but still more spending at the fiscal level, plus you've got counter tariffs and tariffs that are making everything more expensive, like how concerned should we be about the cost of living increasing?
Well, we did upgrade our inflation forecast from slightly below 2% year-over-year growth. So again, this is growing to slightly above 2%. And that incorporates things like the retaliatory measures that we've seen from governments. Those will actually increase inflation for Canadians more than they will for the United States, just like US tariffs create inflation for the Americans more so than in Canada. But Canada hasn't been dealing with the same sort of inflationary pressure that the United States has. Again, we experienced that big one-time upward shock, but now our growth rate over a period is still relatively healthy. Now, the Bank of Canada is going to want to keep it that way. This is in really stark contrast to the United States, where forecasts for year-end inflation are back up a near 3%. We see core inflation in the United States rising to 2.9. Now, that might seem like a lot of random numbers, but it's way above what the United States wants their inflation number to be. So at the end of this, we actually expect that higher prices will end up weighing on Americans much more than Canadians. And that, of course, doesn't exclude the fact that we still had that 20% increase. Prices aren't going to fall from this level. They're just going to rise more slowly than they have in the past 4 years.
Okay, I'll leave it there. Ms. Donald, thank you so much for your analysis this evening. I appreciate it.
Thank you for having me.